Late, bro. We're late. We're like 6 minutes late. But hello, everybody. I usually start at 9:20. It's 9:26. It's probably the crappy connection. No, honestly, it was just us getting set up. It wasn't the connection. But hello, everybody. Thank you for being here. Vegas time is different. Well, it's still 9:26, so it's 6:26 here. And the market is green. The market is very, very, very green. Well, not that green, but like it's decently green. Ahad, what's up? Mod, what's up? We don't have the bell because I couldn't get it through customs. I mean, I didn't even try. I was
cowbell.
You think I could have?
If you try, it's a cowbell.
Yeah, but it's like metal. What if they were like, oh, you're gonna bust open like the person's head in the airplane or something?
No.
Like they would have seen it as a weapon or something.
Not how it works.
Okay. Well, anyway, let me just tweet this live. Market open.
Don't forget to tweet it to your Discord.
I don't forget anymore. I'm pretty much every day I've been doing it. But we're green. We're green. And
green.
All right, bro. It's 6:26, and like
these walls are thick.
The audience can hear you. Viva Las Vegas Submit. What's up with Palantir? We'll check it in a second. There's no customs. Yeah, I just thought they would yell really loud at open. I thought they would make it a big deal, so I was just like, let's not even try. Okay, so let's look at the market. Palantir 753 up 2.6%, up 770 pre-market. Snowflake up. Wow, Snowflake got to 165 yesterday. I didn't even see that. It's up 170, 3.26. Apple 150, 152 actually. Apple's been interesting because going below 150 was something a lot of technical people, at least on CNBC, were talking about, is something to be aware of. 74 on Zoom pre-market. ARK up 2.5%. ARK Innovation ETF bought, ARK in general, plus the ARK Genomics Fund, bought about 1.4 million shares of Ginkgo Bioworks yesterday. So that was the big buy for ARK. What do we got? What do we got? Tesla. Tesla is 283 pre-market. So up about 2.82%. Tesla has fallen well below its $300 range. It was not able to hold it up, which honestly, you did not need to be a rocket scientist to know that was going to happen. But Tesla is holding up at least a little bit better than it was yesterday. Google's back at 100. Oh, it's 99. Well, when I woke up at like 5 a.m., it was at 100. Pinterest up 2.51%. It's interesting what's going to happen in the market open. If this is actually going to retain itself, or it's going to just get completely demolished right after. Bro, LOL, how often have you traveled? So I traveled a lot in high school, like a lot for high school debate, domestically and internationally, because I was on the USA debate team. But like, I don't know, sometimes I think like to just have a good experience and not have any trouble. One of the TSA agents was making a big deal about our cameras. They were almost telling us you have to take out every single lens. And we were just like, what? Like, this is ridiculous. So I was like, if I have a cowbell, I feel like it's just going to cause more issues for no reason.
You could have said it was a Christopher Walken present. Like, said in the chat.
I probably could have. All right, we are 27 seconds away from the market open.
Ding, 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 ding.
Dude, can I get a cowbell on YouTube?
Cowbell. Of course, you can get anything on YouTube.
Okay, here we go. You can't get porn on YouTube.
Sure. That's right.
Yeah, you said yeah, you can't. Do you know a different type of YouTube, Tristan?
Bro, there's like fart fish. And on audio.
And on audio. Oh, here we go. All right. As soon as the market opens, I got to share my screen, though. I got to share my screen so we can share the sound. Okay. The market on September 27th, 2022 at 6:30 a.m. California time, or West Coast time, and 6:30 and 9:30 Eastern time is now officially open. That was so anticlimactic. Oh my gosh, that was so bad. Okay, anyway, let's get into the open and let's see how green this actually is. So we've got, first of all, Bitcoin. Well, that's Bitcoin's at 20,000. It rallied last night, up 5%. Not bad on Bitcoin. Salesforce is trying to get to 50 billion in revenue by 2026. I've never been interested in the stock, but I do love the CEO, Mark Benioff. The co-CEO of Salesforce is also like the guy on the board of directors of Twitter. Oh, by the way, Elon Musk is not testifying apparently in the Twitter case. His lawyers like refused or something. So we're going to see some updates on that probably in the next day or two of like what's actually going on. Open Door 318 up 4% today. SoFi up 3%, 2.76%, but at 522 still, relatively lower from 640 a couple weeks ago. But at least it's up. Nvidia being under 130 is just fascinating to me. This company is like, when you get into the tech, I was talking to Ticker Symbol U about it. It's just insane the stuff they're working on, but the stock is not being valued.
I want to say something.
Go
about
ahead.
that.
You got it.
So remember when I went to the Vault conference?
Yep.
Well, there was this guy who worked heavily in the sector, and we were talking about chip stocks. And I said, "So, what is your favorite chip stock of all of them? What is your favorite and why?" And he said to me, hands down, Nvidia. Yeah. And this is from a man like in like that knows, and I can't even recall all the things he told me, but I do remember them being really freaking amazing. And I was like beside myself because I didn't know the things that he was saying. So
yeah, and I don't understand the tech. I'm gonna be honest. I don't know the tech, to be honest. I know the like chips and stuff, but I'm not that deep into it. Where my like Palantir, most people don't get Palantir's tech. I would say at a high level I do, and even at some level of technicals, I get it just because of the conversation I've had with CodeStrap. So I can't go Nvidia yet because I just don't get the tech.
Zim? How much is Zim up? Oh, just a percent.
Zim is up about 1%. Meta is at 137, which is interesting. On a green day, look at this. Meta got to a 52-week low of 136. Google's 52-week low is 98. Google recovered to 101. Meta can't even get to 140, which was or 141, which was like the previous 52-week low. So Meta's getting demolished. And it's having a run. Do you think Meta can recover from these levels? You think it will? Obviously it'll recover. But
in order for them to get to the all-time highs that they were, they will have to succeed in the VR things that they're trying to achieve.
Yes, let me get through some comments. David, I did see that Twitter DM you said yesterday about the merchandise, so definitely that was super, super helpful. Thank you for saying that. I got to respond to that. I think that Printful website is actually going to help a lot. Is that Tyler Durden? Is Gabe Tyler Durden or the narrative? You watched Fight Club, right?
Yeah.
Okay, it was a bad movie, but that's a good joke.
I love Fight Club.
No, Echoes is here. Echoes is here. Echoes, thanks for joining the stream. I hope you're enjoying your morning. All right, let's go to the talking heads on CNBC, and let's see what they're talking about. See, it's so interesting. So some are saying it's a buying opportunity. Okay, let's look at some bullish news by Gene Loopster. This guy's a relatively smart guy. 2023 is a buying opportunity for tech, or a great year for tech. Let's see what he has to say.
Been talking about some of your quasi comforting comments about a potential rally in technology, but we're paraphrasing it with a bear market rally. So what if it was a rally that turned into something more than a bear market rally? Would you just change your tune, or are you sure that it's a rally in a bear market that's destined to fail, or could it be something more than that?
I would say there's a 20% chance it's something more than that. The reason I believe that this is I think there's going to be a rally. That's the positive. I don't want to bury the lead here. The reason I think it ultimately fades is that the Fed has public enemy number one, inflation. They have a dual mandate that's stated, but they have drifted away from that. The key factor here is inflation. And their ability to continue to fight that is going to be the biggest mechanism, of course, is going to be through interest rates. And that is negative for tech. I just fast forward 2-3 months from now, I'm thinking about that CPI number and think that it's less likely that we're going to see the CPI numbers sub 4%. We need to get down to those kind of numbers before the Fed starts to back off. So, Joe, the spring is pushed down hard against these tech companies. I want to quickly frame that in. And I think that it pops up here, but ultimately this continued persistent higher rates longer is going to be negative over the next, call it 6 months. And if I can just kind of quickly frame in the optimistic side, there is an investor piece to this, and then there's traders. For investors, the formula is pretty simple. You own the strongest company, that being Apple. You framed in what's happened with Meta and Netflix and broader NASDAQ down 31%. Apple's down 17%. Some people say that's a reason for it to pull back. I believe that the reason why it's down 17% is they're fundamentally in a good place with their products. We've teched iPhone.
Guys, real quick, I don't know if you just saw on the video, some of you watched, some of you listening, Kathy Wood exclusive is on CNBC in today. So that'll be interesting to see where her head is at. She had a tweet yesterday. We're going to talk about deflation and interest rates, but let's finish off with this.
Day through lead times, they continue to be elevated. Usually you see them pull back, but that is, I think, a safe haven Apple. And if I can quickly kind of frame in this spring back related to some of these other tech companies, there were 10 high flyers, or I identified what I consider the biggest 10 high flyers in 2021. Those stocks on average are down 70% year to date. But what really caught my attention in anticipation of this bear market rally is that they have an average short interest of 12%. And typically these types of companies would have a 3 to 5% short interest. Big tech has a 1% short interest, just to give some perspective. But that 12% short interest can spring back nicely. And this is not investment advice, but I think you could see some of these companies back up 30% in the next couple months.
That's what I mean. So I don't know. So if it were a 50% retracement of the sell-off, that's definitely a tradable bottom that you're making. But I don't know if you actually need to keep calling it a bear market rally. Would you have a problem long-term holding these stocks from these levels? Because if you're saying it's a bear market rally, let's say it has a nice bounce like you just described, you expect new lows. If you don't expect new lows, then why are you calling it a bear market rally? If you're not expecting it to retrace all of the bear market rally to new lows where you can even get a better entry point, then why not just call it an entry point now for
So this is an interesting question. As we see here from Jan 5th, Dow down 20%, S&P down 24%, NASDAQ down 33%. So if S&P and Dow get to 33, then where it's like a real bear market, right? 30, 35.
What do you mean a real? It's a
Well,
bear
that's the
market.
technical, but yeah, but
No,
30.
bear market is 20%.
Oh, 20%. Okay. Well, so 35 is like
30, like
like
if
the sky is falling.
If the S&P was at 35%, that the people would be saying this is the end of the world. Like that's how bad it would have to be, which it will get there. Mark my words.
So
Eventually.
let's see what Gene says here.
Yeah.
stocks like Meta? If you loved it 62% from here, if it's down 62%, maybe this is just an entry point, not a bear market, not a rally, not just a tradable rally.
That's a fair perspective. My sense is that the reason why I'm not calling it, the bottom or just own through that is that I could see this, I talk about a 30% over the next couple months. I think you could see kind of a retracement. Maybe it doesn't give all of that 30% back, but enough of a retracement where people will say that this was a false start. Ultimately, you're getting to the real A topic here, which is what's going to happen with these companies in 2023. And I think 2023 is going to be a great year for tech. I think all of the pain that we're seeing right now is resetting growth rates. We're going to get back to higher growth rates. Loop does own Meta. I didn't highlight that one as a safe haven because there is a lot of controversy around it. But ultimately, I would agree with that perspective, is that if you have the luxury of owning some of these for a year plus, these are the opportunities. In the time that I've been following tech, I can't remember, actually I can remember 20 plus years ago after the .com, I think there was a sense that these companies, all of them are going away. But I think if you have a perspective that you can hold something for a year and a half plus, I think you'll do well, even with these high flyers or the big tech.
Is it possible?
All right, that's interesting. So that's a new perspective by Gene, at least from what we got from mainstream media, that 2023 is going to be a year where DCAing makes sense, or at least initiating the positions make some sense. Let's look at what Kathy said, because Kathy said some stuff that is also interesting as of yesterday. Obviously, Kathy and Elon are anti-interest rates because it hurts all of their core stocks. So they are going to get their ideas out there to try to get the Fed to not do this. So Kathy says the yield curve suggests that the U.S. monetary policy has not been this restrictive since the 80s. As measured by the 2-year Treasury yield relative to the 10-year Treasury yield, it is inverted by 50 basis points, 10-year at 3.7, 2-year at 4.2. In ARK's view, U.S. monetary policy is significantly more restrictive than in the 80s to kill inflation. So she thinks what's happening right now is crazier than what Volcker did. Fed Chair Volcker pushed the Fed's fund rate twofold from 10 to 20%. Chair Powell and team have increased it 13-fold. Do you think that has any mainstay to it? That's interesting. Under Volcker, the increase in long-term treasury yields was 1.6 from 10% to 16 compared to 7.4. Risk aversion is plumbing all assets except cash.
So hold on, let me tell you why that's not. I don't agree with her.
Okay.
Right? If you have a stock that's at $100 and it goes from $100 to $200 or 1 billion to 2 billion market cap, that's a lot, right? But if you get a stock that goes from 1 million market cap to 2 million market cap,
Yeah.
right? You always say that, which I hate when you say it, but you always say it. You're like, it's easier for a penny stock, and technically it is because of the way the way the
float, all
market
that
works.
stuff, yeah.
But that's why that undercuts what she thinks, because if when to go from 10% to 20% is a lot harder than to go from 0.25% to 3.25%.
It's like Google going from 1.6 trillion to 2.6 trillion.
Exactly.
Right. So you think she has a point?
No, I disagree with her. Although it is more numbers, like it is
okay.
13x
Versus 10,
more versus 10. It is still easier to do and not as like crazy to think of. You understand? In my opinion.
Interesting. No, it's a very good point. And Kathy's been known for coming up with these narratives to justify her views of inflation. And like, I mean, it's an interesting argument, but it's purely 10 versus 13. It's not looking as, I guess, as deep as you kind of just took it in terms of how easy it is. Commodity prices have dropped 42% since their peak in mid-2008, 25% since lower in 2011 and 19. So because commodities are down 19% this year, she also says that is deflationary. 58% increase in the trade-weighted dollar since early 2008. The inflation surge in the late 70s, early 80s has been brewing for 15 years, starting with the Vietnam War and Great Society social programs and exacerbated by the end of the gold exchange. By the time this Fed tackles the current surge, inflation had been brewing for 15 months, not 15 years. Now it is, so she's saying because of what was going on in the 60s, inflation had already been doing what in 70s for 15 years. This has only been a 15-month phenomenon, and we're being too hawkish because we are tackling it as if it was a 15-year phenomenon. Interesting point. She's doing some macro. Japan and China's dollar shares.
I want to highlight this. You see what she's saying about the dollar?
Yes.
Because she's right. An increasing dollar hurts the rest of the world. It creates a very big imbalance. Like, look what's going on in the UK right now, right? For like the first time in like ever that I can think of, the dollar is above the pound.
Yes.
Now, let me tell you what I think is going to happen, and I want to make this very clear. I think gold and silver at some point pretty soon, once the dollar does finally start to drop, gold and silver are going to start to take off. If you look at the chart on gold and silver, gold is literally it's springing down for a pop-up. Technically, it's poised to buy. I'm very bullish on gold and silver, and it's because of how parabolic the dollar is going. Right. They go in opposite. Like when the dollar's high, gold is low. And then so what's going to happen soon, I think, and soon is a relative term, right? I think that soon gold, the dollar is finally going to give the rest of the world a break and start to come down. And that's when the gold is going to have a I don't want to say parabolic, but it'll have a nice rise.
Do you know a ticker symbol for gold on Webull?
For gold, GLD.
Oh, GLD.
Yeah.
We gotta get the actual. Let me get. There's a good website I know that could give us GLD.
Oh, if you want the spot price for gold,
yeah.
So GLD follows it close, but if you go to apmex.com, you can get the spot price for gold.
Because Palantir had their share of gold at like 1,700. They bought. Oh no. I think 1,700. So they
look at that. Gold is at 1,600 an ounce, bro. That's low, man. That's low. If
it's interesting because gold was at 1,000 in 2010, so it's barely even. It hit double a little bit.
Well, no, but it does go up. But listen, and I agree with this. I think that every investor or a savvy person should have up to 10% in gold. I prefer physical gold, right? If you're that kind of person who has like the doomsday thinking, because if the economy ever collapses, at least you have gold to like trades and stuff. But I think hedging your worth in actual gold, whether it be a gold ETF or physical gold, I think up to 10% is very smart. And I just wanted to share that with you.
Yeah,
thank you.
Okay, this is a buying opportunity for many investors. We have some more bullish news. Let's see.
that the Fed would stay at the easy party too long, could stay at the tight party too long? Could the pendulum swing, and could they make a mistake that way? It would just seem fitting and so symmetrical.
Yeah, Joe. So in terms of what we're expecting is kind of just that. The Fed is going to likely overdo things here. And if we look at their projections from the meeting, their most recent meeting, you can see that they're at maximum uncertainty across almost all of the components that they're forecasting right now. And they're still going at this very aggressive clip of rate hikes. We are expecting at least another 75 basis point rate hike for them to deliver. It's almost like them going at 75 miles an hour without necessarily knowing where the next turn in the road is ultimately going to be.
That's perfect. That's fitting. So they really don't know what they don't know, but they've admitted that. I would think that's the first step towards. I would think that's the first step towards recovery, is admitting it. But then I'd slow down to maybe 35 or 40, and that's not what's happening.
Well, that's right, because what they do know is that they need to get inflation under control. And ultimately what they need to do here is inflict some pain on financial conditions to basically get that cooling that they desire on the labor market. They're kind of using a nice term for this, right? Rebalancing the labor market. But what ultimately this means is they need to drive unemployment higher. It's an unfortunate cost of this, but ultimately, because we face very strong demand inflation here in the U.S., this is the medicine that effectively the economy needs to take here.
Well, I'm going to get to Sherry, but just one last thing. Yeah, we have that now, but the participation rate is low, and we paid people to stay at home, and now everybody is talking about hybrid work. I don't know if it's really the classic tight labor market that we saw. So they may be going after the wrong thing, and you may end up hurting the rest of the economy for.
What he's talking about here is Powell on the Fed meeting said that the labor market needs to cool off. So there's too many jobs or too many people or too many jobs for too little people. And as a result of that, that's causing the wage price spiral still. So if companies start having layoffs, your job gets more secure. You want to fight for your job. More people want to show up to work, and that cools off the market. Obviously helps with inflation. So it's interesting to see how Powell's caring about that more than most things.
What wasn't a classic labor market, a tight labor market that we've seen in the past.
Certainly, Joe, but what they're in the process of doing now is ultimately winding back a lot of that accommodation that we saw post-COVID. You mentioned in particular, the fiscal stimulus that we saw. They're in the process of winding that back, and the Treasury market now has to digest more debt than really it has been over the past couple years, with the Fed not in the market anymore. And this is causing a lot of problems for the Treasury market that we've seen really over the past couple days or so, just the incredible rate volatility that we see in U.S. Treasury, supposedly the most deepest liquid market in the world.
And Sherry, I don't think you should switch yet to fixed income. Stick with the, for managing wealth. But 430 is not bad for 2 years. You got to admit that. That hasn't been something you had to worry about before. I think at this point, Sherry, you make a good point. You want a rebalance next time you think the market's at a point where it could be bought, and rebalance with stocks that will do better in an inflationary rising rate environment. Should we do that and actually buy some things?
Yeah, look, I think we're at a crucial moment where we really need to get investors out of the old party scene of the Fed and into the new party of forward thinking around profits and earnings, and step out of the economics of the politicized bond market and really take a look at what the opportunities are in the science of the stock market, which always tells us that winners become losers and losers become winners. We're in a market reset right now. We've got 11 sectors of the S&P 500. 30% of the stocks on the market have already retested their lows. Regardless of the debate around the broader market retesting lows, it's a buying opportunity for many people. And if I had a choice between stepping into the politics of the bond market or capitalism in the stock market, I'll take the stock market every day.
You're preaching to the choir here. And you're talking about today. So these issues that you're talking about have already retested the lows enough to where you feel comfortable buying right now and recalibrating your portfolio. Okay.
That's right. The biggest thing, though, I would encourage investors to understand, we're in a massive leadership change that in the 20 plus years I've been managing money, we've got to take stock of that. So you want to barbell portfolios towards present value cash flows, and then anchor the far into your portfolio against what I call idea maturation, centered on innovation, but present value cash flows, moving from dividend payers, not enough. We got to move to dividend growers on the front end of portfolios, and then center within sectors, separating out staples like tech staples versus tech innovators, healthcare staples versus healthcare innovators, and further sort of delineate that within your sector choices. And obviously the security level is crucial.
Shepard Smith here.
Yo, Shepard Smith is my guy, bro. So it's interesting. We had two bullish videos around stocks being a buying opportunity. Gabe, you still think these are not buying opportunities, correct?
Okay, no. So listen, it depends, right? It depends.
But gun to your head, if I said you have to buy right now, you would say I don't want to buy.
No. I'll explain to you why it depends. So if you are not understanding what is coming, and if you want to buy now to hold, right? If you want to buy now to hold, most of the time, because nothing is 100%, most of the time for most companies, I wouldn't do it because I believe lower lows are coming, right? So why do it? However, if you don't really know the technicals and how things are panning out, like I think they will be, like I'm very sure in what I think is coming. So therefore I'm going to do what I'm very sure in. But if you're a normal person, then I believe that dollar cost averaging into great companies is the thing to do. So that's why it depends. You understand? Yep. For an investment, for a trade, I believe buying now is very smart. For a trade, if you can put a trade and then have a trailing stop loss just in case I'm wrong, and it keeps on going down, sure, whatever. But I think we can get it cheaper later, and that's what I'm gonna say. But that's dangerous to say because
that's
everyone.
That's what you prefaced it. Whereas if you don't really care about the market day to day, then you dollar cost average. All right, we've got Kathy Wood. Here we go.
Get your sense of where we are in this economic cycle, if we could, and really, I think, given the conversation we've been having all morning, has inflation peaked?
Yes, well, it's very interesting to hear people saying that we'll be able to skirt recession. We believe we are in a recession. The durable goods orders we just saw, really we're seeing the strength there because of activity being attracted to the U.S., a flight to safety. That's why our dollar's been going up as well. Nonetheless, we think we are in a recession. We're seeing tremendous demand destruction. You see demand for gasoline over the summer down to 25-year lows, 1997. Think about that. So lots of demand destruction, and we believe it will continue. The good news here is to hear Michael Evans this morning talking about, hey, we're all on the same page. This could be done in the first 3 months of next year. Well, if the market is the discounting mechanism that it should be, then it should be discounting the peak in interest rates. Yes, inflation peaked. We believe core inflation peaked at 5.3%. This is the PCE deflator that the Fed supposedly pays the most attention to, 5.3 in February. It's down to 4.6. And with all of the price declines that we are seeing out there, whether it's in retail because of too much inventory or way up the pipeline with commodities really falling out of bed, all of them, we think the inflation rate is going to be surprisingly low.
So again, two core arguments. Core inflation has decreased from 5.3 to 4.6. She's saying it peaked at 5.3. And because commodities and a lot of other things are down from their peak in January, Kathy is saying that inflation will come down. And that's why she's remaining bullish on a lot of the growth stocks she's picked.
We would not be surprised to see deflation month to month sequentially for a number of months during the next 6 months.
Does that mean that you are betting that the Fed eases up in a way that they have not signaled thus far?
Absolutely. I think they do not appreciate how much demand destruction has taken place out there. But this holiday season, I think, will be telltale that way. And so I do think we're looking at a major pivot. If we're right that deflation, and we've been saying this for a while, so consider the source, but if we're right that deflation, both for cyclical reasons and for secular reasons, all we do is look at technology and the cost declines associated with different technologies, and they're massive. So we think that inflation during the years ahead is going to surprise significantly on the low side of expectations.
And then how do you think that the Fed balances both the issue of credibility, given what they have signaled about the market, with the data that you're suggesting they're not appreciating just yet?
Well, I think they have been basing their outlook and their policy on two lagging indicators. Seems they've been paying more attention to the CPI year over year, which is still at over 8%, and employment. Both of those are lagging indicators. The leading indicators, which are all in the pipeline, easy to see right now, are all saying that prices are going to come down. Inflation certainly will come down, but I think the big surprise out there is the number of months we will see actual deflation, negative prices. And it's not just because of the US. In fact, we're benefiting from the flight to safety from the rest of the world. What's going on in China is highly deflationary. What's going on in Europe, the same. This energy is a huge tax on that continent. One of the other things that's happened in the last in the last week that I think is fascinating is that both Japan and China have basically supported their currency, and they're basically saying no mas. And in order to do that, what are they doing? They're selling dollars and buying their own currency. So effectively, China and Japan are doing some of the easing that we think the Fed will do, increasing dollars in the system.
Okay, so incredibly interesting what Cathie Wood just said. We have a Wejo PR I want to get to, but before we get there, Cathie Wood said core inflation or CPI is a lagging indicator versus a leading indicator. Gabe, can you educate us a little bit on what exactly is the difference and why she's saying that CPI doesn't matter?
See, I disagree with her, but I'll just say this. So, I mean, it doesn't take rocket science to figure out that a leading indicator means that as something happens, it starts to affect the market because it's a leading indicator. As you find out something, it starts to affect it. A lagging indicator is when something happens later on, it starts to affect the market, right? It's a lagging indicator. I don't agree with her with the CPI, so I'm not going to say too much about that. And to side note, before I forget, where's the camera? Right there. Yeah. Hey, Brian Tavares, I want to say I saw your comment on that person's page, and I just want you to know I appreciate you. Thank you very much.
Okay, very cool. So the Cathie stuff is super interesting. We're going to get into back into it in a second. Wejo, with the company that flew me out to Las Vegas today, just had their press release in real time. I honestly don't even know why I'm here. I'm going to be very honest. They haven't told me anything about this event other than it's something new. So this is what they're talking about today, apparently. All right. This is a Palantir SPAC, by the way. Wejo, a global leader in smart mobility for good in cloud and software analytics for electric and autonomous vehicle data, today unveiled Delivery, an AV prototype that is being used for develop and demonstrate Wejo's autonomous vehicle operating system software that will use live, real-time connected data to support development. The AV prototype allows Wejo to build, test, and demonstrate Wejo's live API data powering APV development projects, including freight, delivery, and robo-taxi or ride-hailing vehicle use cases. The initial prototype was showcased the first time during their Data in the Desert on-track driving event in Las Vegas, which is why I'm here. Delivery represents the next stage of evolution for AVOS that will demonstrate how AV developers can be able to utilize connected car data that integrates real-time parameters, including the number of cars on the road, construction barriers, pedestrians, cyclists, slippery tools, and other dangerous weather and road conditions. Almost like, I guess, their own little version of Tesla's FSD, but not using Tesla's proprietary data, but using their stuff. The prototype will also support the standardization of a common connected vehicle language for AVs. So this is so almost like licensing this software to all these other companies for them to be able to use, along with informing digital twin testing. To be clear, Wejo is not entering the race to develop autonomous vehicles, but we are propelling AV adoption forward. I mean, they're not making their own cars, but they're propelling the software that powers them. And the prototype we're developing will use Wejo's AV OS can empower its developers. Richard Barlow, we want to help reduce the 1.3 million deaths that happen each year on the road, an additional 8 million due to emissions. Instead of learning from historical data, or edge-based processing of live API data will provide intelligencing on long-range conditions across traffic. Edge-based is their edge-based AI that doesn't need like an internet connection to be able to make real-time decisions. Very interesting. So today they're going to show me the capture of light detection, use of cloud-based road intelligence, enabling vehicle-to-vehicle communicate LiDAR, and intelligent internal and external displays. Now, again, I didn't even know this was happening, so I'm going to see it today. I'll give you guys my objective take on what I see, but super, super interesting that they're doing this. Wejo has always been a very interesting company for me to analyze. I've historically said I'm not a fan of the stock. I really don't even know that much about the financials, but the tech is interesting, and today we're going to see a lot more about the tech.
Speaking of that, we should definitely see if we can visit the underground Tesla tunnel.
They have that here?
Yeah, that's here in Vegas.
Okay. Interesting. A lagging indicator isn't what he said. It's information that we don't get until now that reflects something that was happening in the past. I feel like that's what you said, right?
Fine.
See, you're learning. Yeah, that's not bad. Wejo has level 4 self-driving cars in 2 cities already. Yeah, incredibly interesting. Okay, so let's go to the ARK ETF. Kathy's arguments were pretty spot on with what she's been saying. At the end of the day, she's been saying that. Now, the interesting thing about that interview, and I'll probably make a video reacting to it right after this, is deflation is coming within the next 6 months. So what? We're in September, October, November, December, January, February, March. She's saying sometime in the next 6 months, we will have month-over-month deflation. And she said the holiday season is going to be relatively good when the market responds to the Fed cooling down. So I think October CPI, which is what the Fed seems to care about, even though Kathy doesn't care about that because she thinks it's a lagging indicator, is going to be the most important thing for her thesis to remain intact. If she's incorrect about October CPI, and we get another 75 and another 75 off of that, we're not getting a recovery in the market for a while. In fact, we're probably getting a really bad crash. But if we get a 50 or 25.
Well, no, we're not supposed to get 2 75s in a row. We're supposed to get a 50 and a 70.
I feel like the market feels the Fed might just do it, right? I mean, yes, we're supposed to get a 75 and a 50.
Yeah, which is more than they told us many months ago.
Yes,
they said 2022 will only have X. I don't remember the exact number, but we are on track to pass that number. They lied to us. They said it'd be slow until 2024. Yeah, my ass. They fucking ramped that shit up. But I do want to say something. I think it's ludicrous that people are thinking the Fed will just flip into quantitative easing again, which means injecting money.
Let me ask you a question. Could they stop raising interest rates, let's say by November or 25, and do quantitative tightening still? Can they still do that?
No, well that is so they have many tools. They can either raise rates, lower rates.
But right now they're raising rates and doing QT.
Right.
So would they stop rates and still do QT, or you don't usually
like
one or the other?
They to get their foot off the pedal, they'll do one of them. But what they're not going to do is what I'm saying is do all of that and then inject money.
Yes,
where people think is going to happen, and that's just crazy. That's not going to happen. That won't happen until we're actually at a close to an inflation number that they're looking for,
right?
Which is like what 2.5%.
2.5%. Yeah. It's gonna be interesting. It's gonna be interesting to see what as Jay Swat said. Isn't the word interesting kind of like a filler? What is not interesting? Well, a lot of things are not interesting. What's not interesting? I don't know. This iPhone case is not that interesting. So I guess some things are not interesting. Problem is the Fed is also fighting a spend thrift federal government. Governments yeah. How do you think Jerome Powell felt when the student loan news came out? Do you think he was just like, this is not good?
Say again?
When the student loan news came out that we're forgiving the loans.
Yeah, I thought that was fucking
But
bullshit.
how do you think?
No offense to you.
How do you? I'm getting rid of my $10,000.
Yeah.
I had $10,250 in loans. How do you think Powell felt when that news came out? Do you think he wanted to like kill Biden?
So exactly right. So it's like saying you're on a budget and then you go buy a Gucci bag, right?
Yes.
I mean, not exactly, but you get what I'm saying.
Yes.
You are conflating the issue to make yourself look good. That's what Biden did, I believe. Like, and I'll just leave it there. I won't talk about politics, but I think that was like literally the worst time. I think it was something because of midterms, and
Yeah, and
that's
you're
why
honestly
politics.
probably correct.
That's why politics suck a lot of the time.
Joel, you're arguing too much about the Wejo thing in Tesla, bro. Like, there can be another company doing autonomous AI for self-driving cars.
Thanks, David. I see your comment. I appreciate you, man.
I've decided Gabe's cool. We like him. Yep. People will eventually agree. Owen beeping, oven beeping. Brownies are ready. I'm celebrating the green day. All right, let's take one last look at the market, and then we'll get out of here. We've been here for 40 minutes. I've got to go to this event in about an hour. Super exciting. We'll let you guys see everything that's there eventually when we upload that video. All right, ARC ending at 38. Well, ending for the live stream. 765 for Palantir, Salesforce 149, Snowflake 170, Apple 152, Wejo $1.06, DNA 286. It's a green day. It's a decent. Where's the S&P? I think we're at 368 on the S&P. 366.
So, fun fact, everyone: the SPY, which mirrors the S&P at about a 1/10 of a ratio, does not. It is not exactly like. Did you know this? It is not exactly like the SPX, the S&P 500.
It's close enough.
It's close, but when I was doing my video the other day and I was measuring out the declines, like the S&P at some point was like, the SPY was like 20 something percent, and then the SPX was like over 30 on. I can't remember. Yeah, like I'll show you like later.
Interesting.
Yeah, it was interesting.
You know, it's not interesting. This phone case. Okay. Anyway, thank you guys for joining. We'll see you late night stock talks today, 7 p.m. West Coast time, 10 p.m. Eastern Standard Time. And yeah, we'll see if this green market holds up. Bye-bye, everybody.